There's been a lot of uncertainty in the market this year, with inflation numbers and interest rates still staying pretty high, causing a slight dip in the market as of recently. But as we know, over time, equities tend to rise at a 5 to 10% rate. So today I wanted to go over a few different ETFs that I think are perfect for really any portfolio that will help drive those long-term gains. Also, the ETFs that we're talking about today do not include SCHD. I know that's always the ETF that everyone kind of looks forward to, but a few of them are very similar, so stay tuned for that, and you can decide for yourself if you think they're better or worse than SCHD. With that being said, let's jump right into the first one, which is VT, or the Vanguard Total World Index ETF. Now, VT is very similar to VTI, but the biggest difference is that instead of holding 3,700 different US-based stocks, it holds nearly 10,000 different stocks, including both US and global companies. So VT is definitely a lot more diverse, but still grows at that 6 to 10% rate every year, including dividends. And what I really like about VT is that it pays a 2% dividend every year, so even when the market is flat, you'll still be guaranteed that 2% in dividend payments. It also has a very low expense ratio of 0.07%, with its total assets being just under 48 billion. Now, one thing to keep in mind of with a fund like VT is that because of how many holdings it has in its portfolio, it can be considered a little overly diverse. So in my opinion, I think it's important to combine this fund with the other ETFs that we're going over in this video to prevent from underperforming the S&P 500. This brings me to the next one, which is SPGP, which is the Invesco S&P 500 GARP ETF. Now, GARP is kind of a funny word, but it stands for Growth at a Reasonable Price. So this ETF tracks the S&P 500 GARP index, which according to S&P Global is an index that tracks companies with consistent fundamental growth, reasonable valuation, solid financial strength, and strong earning power. So in its portfolio, you can see that there's a good mix of both energy companies at 28% weighting and technology companies at 22% weighting, with some of the top companies consisting of Diamondback Energy, Marathon Petroleum, Devon Energy, and KLA Corp, which is one of my favorite semiconductor companies to invest in. So it's a really unique ETF in the sense that it isn't only holding those really popular, fast-growing technology companies. SPGP currently has a 1.31% dividend yield, with a slightly higher expense ratio at 0.34%. But in my opinion, holding an ETF like this is totally worth paying that fee every year. I also think that it's a perfect ETF to pair with a fund like VT or even VTI because they both grow at a consistent rate every year, but also have a very low overlap. As we can see here, SPGP and VT only have a 10% overlap when comparing their holdings. Another one of my favorite ETFs is SPLG, or the SPDR S&P 500 ETF. So this fund is very similar to ETFs like SPY or VOO, but one of the best things about this fund is that it has one of the lowest expense ratios out of really any ETF out there at 0.02%, which means you're only paying $2 for every 10,000 you invest, so definitely on the lower end when it comes to fees. It also pays a 1.38% dividend yield with just under 34 billion in assets under management. If we look at its holdings, and with it being an S&P 500 fund, it holds some of those classic large cap growth companies like Microsoft, Apple, Nvidia, and Amazon in its top 10, with over 500 different stocks in the portfolio. So I think SPLG is a perfect ETF to hold in really any type of portfolio to get that consistent long-term growth. I'd even argue that it's more superior to both SPY and VOO, but that's of course up to you to decide. Now, this last one is also great for that long-term growth, but does come with a little bit more risk. It's SCHG, or the Schwab US Large Cap Growth ETF. So this fund is managed by the same firm as SCHD, the dividend ETF, but rather than focusing on dividend growth, it's only centered on high growth, which is why the dividend yield is only 0.44%. And with it being a sort of high growth ETF, it's always going to beat the market when we're in a bull run. But when the market goes red, it tends to fall a lot more aggressively. And we saw this in mid-2022 when it dropped nearly 34% off its previous high. So the volatility is definitely something to look out for, but all in all, it's a really solid long-term growth ETF. I've been holding SCHG in my own portfolio for a couple of years now, and I can honestly say that it has not disappointed. Jumping into the portfolio, we can see that its top 10 is very similar to an S&P 500 fund, but there's a lot more weighting towards large cap growth companies, with Microsoft being at 12.4%, Apple at 10.3%, and Nvidia at 8.5%. And these top 10 companies make up over half the entire 250 different holdings. So if you're looking for a high growth ETF that will make your portfolio work a little harder, and if you're okay with slightly more volatility, then SCHG should definitely be the first pick. But let me know what you guys think of these 4 different ETFs. And as always, thanks for watching, and I'll see you next time.